the largest pharmacy chain in the United States and publicly traded on the New York Stock Exchange. With over 9,900 retail convenience store locations combined with pharmacies and over 1,100 medical walk-in clinics, I chose CVS Pharmacy because it recently integrated additional pharmaceuticals and healthcare options into its corporation with acquisition of Aetna Health Insurance, a company that my father happens to work for. CVS purchased Aetna for $70 billion, putting them $45 billion in debt over the investment. But don't worry, the company is nowhere near going under, as it is the 8th largest corporation listed on the 2019 Forbes Fortune 500 list. Plant, property, and equipment is also referred to as plant assets. They have 3 defining characteristics to qualify as such. 1, it must be a physical substance with size and shape. 2, it has to be used in the operation of business. And 3, it is not intended for sale to customers. These are fixed assets with anticipated long-term use out of them, like machinery, equipment, or buildings. When reviewing the plant assets sheet online, the consolidated financial statement of the net property and equipment for CVS includes land, building and improvements, fixtures and equipment, leasehold improvements, software, and accumulated depreciation. Other items in the footnotes are goodwill, which comes from the high price that CVS paid to purchase Aetna. It is the unamortized access of the purchase paid. It is calculated through the acquisition method of accounting, which is the business combination that is used to measure any goodwill or gain on the transaction. Another footnote on the consolidated property and equipment sheet is the intangible assets. These are amortized over their estimated useful life based on future cash flows attributed to the asset. Examples of these are trademarks, licenses, consumer lists, patents, and brand equity. These are mentioned in the footnotes because they are used for the operation of business and are not intended for the sale to customers, but they do not have the necessary attribute that a plant asset needs, which is being a tangible good that occupies space and size. CVS uses straight-line depreciation method, which means that they expense the same amount of depreciation for each year of the asset's useful life over time. In the footnotes, we also see that depreciation in 2016, 17, and 18 was a $1.7 billion expense for CVS and included the amortization of property and equipment under capital lease. Estimated lives for building improvements, leasehold improvements is estimated to be between 5 to 40 years. The estimated life for fixtures, equipment, and internally developed software is 3 to 10 years. The formula for the straight line method is to take the cost and add it to the salvage value, and that equals our depreciable cost. After that, we take the depreciable cost and divide by the useful life of the asset in years to determine the annual depreciation expense for the asset. By completing this equation, we can find the dollar amount per year that the asset is expected to depreciate at during its useful life. In the millions, the 2018 gross property and equipment for CVS was $26,869. After subtracting the accumulated depreciation and amortization of $15,520, we end up with the net property and equipment, which is $11,349. Compared to 2017, this is only a slight increase in book value. By assessing CVS Pharmacy's annual report and using the internal accounting policies and procedures learned in class, we are able to evaluate the consolidated plant, property, and equipment for 2018.